So this is where we left off last week. We had just covered yield to maturities on bonds and how we calculate yield to maturities given the price of the bond. And now we're going to talk about the number two source of risk in bond investing, and that is default risk. The first one was interest rate risk, right? And that's where as interest rates go up and down, we saw bond prices also go up and down, but they move inversely. So that if interest rates go down, bond prices go up, right? So that's a source of risk when you invest in bonds, because interest rate changes will change the price of your bond. The second major risk on bond investing is default risk or credit risk. So credit risk is the risk that we define as default by the issuer. And what I mean by that is that if the issuer of the bond, and the issuer could be a company or it could be a government, they sell the bond to you and they collect your money. That's their loan, if you will. And then they're responsible for making coupon payments, and then par value at the end. If they do not pay a coupon payment or they do not pay the par value payment at the end, they are in default, okay? Because they didn't pay something that they owed at by a certain time period. And so the risk of this happening is credit risk. And you know, this is pretty analogous, similar to consumer credit market. The company market for bonds and this credit risk or that we have is quite similar to how it works with you and me when we take out a loan, right? So companies that lend money to borrowers, to individual citizens, they're going to do credit checks on you, right? And because whether or not you pay back that loan that you're getting is a source of risk to those companies. And so all the things we're going to cover today, you can draw comparisons between the bond corporate world and the consumer credit world. Now, one thing to keep in mind when we talk about credit risk, kind of by definition or convention, we define the U.S. government as kind of the safest debt. We call it, risk-free, essentially. And people could debate whether anything can be risk-free, but for all intents and purposes, when we analyze different bonds, we usually always compare them to the U.S. government being the safest. Okay. Now, that's not to say that any government around the world is like that. There are some governments in the world that have defaulted on their debt, because governments certainly have to raise a lot of money to operate, right? They can't always get everything they need in taxes. Sometimes they need some money up front to do some big programs before the money comes back in later. And so governments are big bond sellers. And it has happened in the past where governments have defaulted, not made payments on their debt. So a basic premise here is that when a bond is riskier, the investor required return is going to be higher, right? If I'm going to put my money in something very, very risky, you better offer me some potentially high returns to compensate me for that risk. So how that applies to bonds is that if you have a bond that's seen as very risky, meaning the issuer has a decent probability of not paying the money back, investors are going to require a high return. And that investor required return is the bond yield to maturity, right? It's that discount rate that we use. So the riskier the bond, the higher the yield to maturity, okay? And so that's a basic premise we have to understand for the rest of today. When we talk about the default premium, what that means is the premium or the extra yield that you have to pay depending on how risky the bond is. And so that extra amount is usually compared to a US government bond in the US. So that default premium is the extra yield to maturity above a US government bond of the same maturity. We have a slide at the end of this chapter. We'll look at default premiums for different classes of bonds over time. And it's kind of interesting because you can kind of see how it kind of goes with the economy and how investors feel in general. So, you know, if you were to try to get an apartment or something like that, or apply for a loan, a mortgage, right? Very often they do a credit check. And a credit check is usually done with a couple different companies. I'm thinking like TransUnion, Equifax, right? So these different companies, what they do is they track all the consumers in the US who have any type of credit history, and they give you a score, right? And that score basically communicates the probability that you have of defaulting on something. I'm thinking, what is it in the credit scores? You know, they go from like a couple hundred up to, I don't know, 800, something like that. And so that's kind of this number range of rating us as consumers. Now, in the business world, where we're talking about bonds and debt, they have a similar system, but the companies are different. The rating companies in this case are called Moody's, Standard & Poor's, Duff & Phelps, and what they'll do is they'll analyze the bond offering, right, and the company that goes with it, and they'll also give it a credit score. But this credit score, we call it a different thing. It's called a bond rating. It's not a credit score, it's a rating. And you'll see also, they don't use numbers, they actually use like different letter grades to identify how risky the bond is. So these letter grades that we're going to look at, there are two main categories. The better one, or the safer one I should say, is investment grade debt. And the riskier one has a couple different names. So it's been called speculative grade. When it first started out back in this whole class of bonds, it hasn't been around forever. It was called junk debt, junk bonds. But over the last few years, it's kind of morphed its name into something that sounds much nicer than junk. Now people refer to it as high yield debt, which is kind of funny, right? Because when you look at something bad and you try to sell it to people, right? Because there are people whose jobs at investment banks it is to sell bonds, and or mutual funds that try to attract investors. Same thing as selling an investment to investors, and they kind of have to make their product sound good, right? So if someone gives you these junk bonds and tells you to sell them, you're like, oh man, how do I sell something called junk? Nobody's going to buy it from me. Well, remember this. It's high risk, right? That's why they call it junk. But what accompanies high risk? Potentially high returns, right? So very high risk bonds have high yields to maturity, right? And so that's where they draw the people in to buy these, is because they have high yields. So now these bonds are typically called high yield bonds. So it's kind of a nice little play that might as well focus on the positive, the potential for high returns, instead of focusing people on the negative and the potential for high default as well. So we got these two grades, investment grade and high yield or junk bonds. So up here are two of the most popular ratings agencies. We've got Moody's and Standard & Poor's. and they'll go through most of all the major bond offerings, and they will rate each bond and give it what we call a credit rating or a bond rating. In fact, when governments or companies want to issue a new bond to the market, they will go ahead and they will, they'll often pay one of these companies to write up the rating. And it's been talked about in the past, especially during the Great Recession in 2009, whether or not this, is really right that they're paying for someone to rate them, but it hasn't really changed. So it's still happening like that, but anyhow. So these are the credit rating agencies, and they have very similar but slightly different ratings. So like up here, this is the safest, right? Okay. And Moody's calls their safe one AAA, and Standard & Poor's calls it AAA. These are very, very safe bonds, okay? All the way down here, these are the riskiest bonds, okay? And then it just kind of goes down like this as you go, that they become riskier, riskier, riskier as you go from AAA to AA, single A, triple B, double B, single B, and triple C. Now we do have those two categories called investment grade bonds and junk or high yield bonds. And that happens right there. Okay, so anything above that line I just put in is going to be an investment grade bond, and anything below that line is a high yield or junk bond. So check this out, the worst of the worst here, single C. So these are bonds that offer little prospect for interest or principal on the debt ever to be repaid. So somebody bought them, right? And maybe they tried to sell them, but they couldn't. And now they're stuck with this C bonds. And who would ever want to buy those? Well, maybe if you were like a person who liked to take part in turnarounds, where they take a bankrupt company and try to fix it and give it a new life. If you wanted to do that type of investing, you would do it through bonds. And those bonds for companies that are near or in bankruptcy are going to be these bonds down here. So there are some like hedge funds or private equity funds where they specialize in turnarounds or acquiring, being involved in bankrupt companies. This is where they do their investing. It's in these really bad bonds down here. What else do we have here? Now, here's another thing. Companies and bonds can move up and down this chart, right? So Moody's and Standard & Poor's, they don't just do this rating once and forget it. They keep updating their ratings for all the bonds that they're following. And they'll update it as often as, it's like getting financial results quarterly. And so if they're following a bond for a company, and that company is a double B, and they're like, you know what, this company has improved their financials this quarter. It looks like, they have they're able to pay all their debt. We're going to upgrade them to triple B. And so that happens. Bonds will be upgraded over the life of the bond, or they could be downgraded depending on how things go. So bonds can move up and down these ratings depending on the performance of the company and their ability to pay back these bond payments. Now, we remember we talked about how riskier bonds should offer the potential for higher returns, right, for investors, so that a riskier bond will pay a higher yield to maturity, right? And so in this case, guess what's going to happen if, let's take the safest bond here, the AAA. What would happen if a AAA rated bond, if the company all of a sudden came upon some really, really bad financial news? What's going to happen? Standard & Poor's is probably going to downgrade that bond. And let's say they downgrade it to BBB. What do you think is going to happen to the price of that bond on the market? Put it in the chat, or just unmute yourself and let me know what you think. Certainly the price is going to drop, right? Because who wants to own this risky bond? So the price is going to drop. But when we do we know, right, with bonds, if the price drops, what happens to the yield to maturity? It goes up, right? So now after this drop, someone's going to look at this bond and they're going to go, wow, it has a really high yield to maturity. I wonder what's going on. Why is that? And they might be interested in it because, wow, it looks like a pretty good return if I hold this bond into maturity. Well, the gotcha is that all the payments may never happen, right? So that's where the risk comes into play. Just because the contract says they're going to make coupon payments and payments all the way till face value doesn't mean they're really going to happen in real life. And so it may have a high yield to maturity. It may promise a high return if the company makes all the payments, but that's a big if. So that's the thing on this chart. As we go down here, right, the yield to maturity is going to keep going up, 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 up as we go down, because the price of those bonds have gone down because people don't want to own them because they're so risky. Fred is it's a website. I think it's run by the St. Louis Federal Reserve Bank, and it's a fantastic source of data. If you ever need economic data, anything like that, it's a really good website to go to. And so that's where I pulled this from. The red line is going to be S&P AAA. You know, there's a text annotation tool. I should really use that. Okay, so that red line signifies the yield to maturity over time for the average of AAA rated bonds. So it's showing the yield to maturity at a given time for a whole bunch of AAA rated bonds. It takes their average, okay? And that's what it looks like over time. The blue line up here, okay, that is BBB. Okay. Now remember, bond ratings are separated into investment grade and high yield or junk. The very top rating was AAA, and then the bottom of investment grade is BBB. So the red and the blue line represent the range of investment grade bonds. Okay? The green is an average of high yield bonds. So I'm going to call this junk, because that's shorter to write than high yield. Okay? So that's what that represents, right? So here's AAA, Here's triple B, and that's the range of investment grade bonds. And then high yield is going to be an average of all this stuff down here, okay? Probably an average of bonds that have, kind of traded recently. That's going to be everything below the line. So a couple things I want to point your attention to on this chart. Notice how there are certain time periods where the difference between these lines changes, right? And so the difference in there is based on the amount of risk in the bond, right? So, for example, in 1988, there was this much difference between AAA and triple B, and there was this much difference here between AAA and junk. Think of that as kind of like a default premium, right? The extra yield based on how risky you are. But notice how during certain times that difference is much greater. Look at right here. And compare that to the default premiums or difference in yields over here. It's much bigger over here, right? Here we have, this is like probably tripled, and this one here probably is about done the same. Those default premiums have tripled compared to what we saw over here. And this happens regularly over time, right? If we, let me go ahead and clear this. So we see these blips where the default premiums or differences get higher. We see it right here, right? Looks like we see it right here. And there are some maybe littler ones, and I'll just bring these up since they're more recent, so we don't have to go back to ancient history. But look at these times right here. The little one right there, and this last one right here looks like it's like February or March of this year. So anybody have any ideas what was happening during these time periods that I just wrote on here? What was happening in 2000, 2001, 2002? What was happening in 2008, 2009?
Some kind of recession.
Recession?
Yeah. We were having problems in the economy, right?
Yeah.
Problems in the stock market. This was in the late 90s, we had something called the dot-com boom. And that was because that's when all these internet stocks really first started going public. And the prices were going crazy. And even some companies were changing their name and putting .com at the end of their name, even though they didn't do anything online, just because they knew once .com was on their name, their stock price would shoot up. And so eventually, investors kind of lost patience with a lot of these companies because they never delivered. A lot of them didn't deliver. I mean, Amazon was the few, one of the few that delivered. There are plenty of other companies that you may never have heard of. I mean, eToys. I don't think anybody on here has probably heard of eToys, right? There were a lot of search engines at the time, Lycos and Ask Jeeves and stuff that I'm not even sure, maybe some of them exist, but I can't think of too many of them.
Ask Jeeves still exists.
Oh, does it?
Yeah.
It used to be you just like asked a question in the box, then it would give you, it was like a search engine basically. Maybe it's different now, huh?
2001, that was also when all the accounting scandals occurred, and that's how the Sarbanes-Oxley Act got initiated from all that.
Yeah.
I can't remember what company it is, though. It's on the tip of my tongue, but I can't remember.
That was Enron.
Enron, that's who it was. I was like, I did a project on it, but yeah, no, Enron.
That was the dark side of accounting.
Yeah.
But you know what? Some people say that was the Sarbanes-Oxley was the Accountants Job Act. because that gave a lot of more jobs to accountants after that.
Oh, yeah, definitely. A lot of companies, they need people specifically for Sarbanes-Oxley to help advise companies on
Yeah,
the
yeah,
different kinds of risk that they might be doing in their company.
yeah. And then, do you guys remember 2009?
I was like, it's
Yeah,
not,
that's when the stock markets crashed and
Yeah.
a bunch of home lenders and stuff. A lot of people had their houses foreclosed from what I remember.
Yeah, the economy went downhill. The government had to step in. They did a lot of public works project to help get the economy going. That's when we got Carlos B. Boulevard. It got repaved and everything. That's when all the money started flowing into Hayward to redo Mission Boulevard. So I don't remember anything specific about 2012, 2016. But I do know there were different time periods in there where people were nervous that the market was going to crash, even though it really didn't crash that bad during that time. There were parts where, you know, boy, the stocks are going up, but I'm not sure. And so there was a lot of investor anxiety over that time period. But I think we all know what this is right here, right? March, February, March.
I have no clue.
You have no clue? Well, you know how the economy, went into a tailspin, and the stock market crashed for about a month, right? So that was COVID-19 right there. So all these things, what they have in common is that the economy kind of dropped out. And so why would the economy going down affect riskier bonds more than safe bonds? Because that's what's happening here. Look at this. Risky bonds, look at these big, how much the yields went up during these times. What's happening here is junk bonds, the yields are going really high during bad economic times. You look at the safer bonds down here, and there are parts where here some of the triple Bs went up, and here's some increases too, but not nearly as much as junk bonds. Why are yields going up like that during bad economic times, especially for junk bonds, right? When you hit bad economic times, you're worried about businesses going out of business, right? And which businesses are most likely to go out of business? Healthy, safe ones? Go ahead.
The businesses are already having trouble keeping up.
Yeah, so those are the risky businesses, right?
Yeah.
And so that's what's happening here. When the economy goes down, investors are really scared about the risky companies. And so what that means is they're selling those bonds of risky companies when the economy goes down. And they're selling the bonds and the prices are going down, right? Because nobody wants to own these risky bonds during bad economic times. So if the prices go down, what's happening to the yield to maturity? It's going up, right? Remember, they always move in opposite directions. So that's the story here. In bad economic times, the yield to maturity, especially for high yield bonds, will jump really high. And the reason it's jumping really high is because people are selling them and they don't want to own them. So the prices are falling on these junk bonds. And we know how to calculate yield to maturity. We use we input the price and the bond payments, and we calculate that R, yield to maturity, in the denominator of our present value equation. So we calculate the yield, and it goes way up when the price goes down. But there's a flip side to this. There's kind of a silver lining. So right here, when the yield has kind of reached kind of a maximum, right? That means the price is really, really low. What's happening on the other side of this peak down here? Look at that. And the same thing holds most recently here during, this is like February, March, when the whole COVID thing was just starting. The yields all of a sudden, after a certain amount of time, and it hasn't taken very long, except for back here, right? Back here was a little different 20 years ago. It seemed to take a long time for the yields to come back down. But except for that, they've all come down pretty quickly. And so if the yields are coming down, what's happening to the prices?
Goes up.
Going back up, right? And so from that bond return equation, if the prices on the bonds are going way up, somebody's getting really high returns on those bonds. But the key is somebody has to have the courage to buy these junk bonds after they've kind of reached a peak in terms of their yield to maturity. I'm going to show you the performance of a high yield bond fund. It's a Vanguard high yield corporate fund, investor shares. And you should be able to see it now. So here it's high yield, right? So then that means it's a risky bond. There's the mutual fund ticker symbol. Okay. And so I clicked on this tab here for price and performance. And I just want to show you something. So here's the performance of this fund, and this covers the last 10 years. Let me show you a couple things here. So look at this right here, and I think that's right around March 2020. All right, I think I better use the text function for now on. I apologize. So there's March 2020. So what happened in March 2020, right? We know we got the whole COVID thing just started then, but look what happened to the price of this fund. It went from about $6 down to $5.20. So that is about a 14% drop. Now, if that happened to you, right, if you had a 14% drop within the matter of, looks like weeks or a month, you'd probably be pretty nervous. But then look at it. After it reached its bottom, all of a sudden it came back pretty darn quick. So that if you bought near the bottom down here, you got a pretty healthy return, at least 10%, over 10% within the matter of another week or two. And you can see similar things back here. It doesn't show 2008, 2009, but if it did, it would look something like this. I'm going to extend the line. That's what it looked like. And I just know that just because I've looked at this before. And during that time, there was like a 30% return if you had the courage to buy when the yield kind of settled out on the low side. But the trick there again is when things look at their worst, are you willing to invest in risky bonds? And most people, they're not going to touch it. but it's a pretty predictable situation in terms of what you see with the performance of junk bonds. You know, as soon as people get their fears, they sell the bonds, the bond prices drop, but then they seem to stabilize fairly quickly. Now, why would they stabilize fairly quickly? Think about everything the government does now to prevent an economic downturn. What are some of the things the government does? One, they do a lot of actions to support individuals and companies, right? So the risk of going under is somewhat mitigated by government actions. The second thing they do is they drop interest rates, right? And we know when interest rates get dropped, what happens to bond prices? They go back up, right? So the other kicker on here is that after the economy goes down, the government starts dropping interest rates, which then affects and helps the junk bonds as well. So, so there are a couple of things going on, but I think that's kind of an interesting thing about default premiums, how the spread between safe and risky bonds goes up and down over time, and it is fairly predictable. And anyhow, it looks pretty low right now. If we were to, you look at the spread right now, and it is quite low. Very close in terms of history. The difference between these interest rates is pretty low. So now is probably not the best time to buy junk bonds if you're speculating. Why do people buy junk bonds at other times? It's because of that extra yield. And right now, with interest rates being so low, some investors, especially those investors who are living off bond portfolios, and some of those might be like retired people, you know, they're struggling because interest rates are so low, they're not getting good returns. And so that's when people feel the pressure to reach for higher yields on bonds, and they reach by taking on more risk. And so there's still a market for this, but it's just a little bit, you know, it's more people reaching for yield to get better returns, and it's not like the time to speculate, if you will. One other interesting thing about these junk bonds, they haven't been around forever. They started in about, I think in the 80s, and there was a famous financier. His name was Michael Milken, and he worked for Drexel Lambert, I think. He was down in LA, and he kind of got credit for starting this whole junk bond market. In fact, his nickname was the Junk Bond King. And what it was is that there, at the time, hedge funds, private investors, there's a market to buy up old companies and then turn them around. And they needed money to do that. And they used a lot of debt to buy these companies. So that made the debt risky, right? It's like buying a house with very little down. That's what these investors were doing back in the 80s. They were buying companies with very little money down. And so, and they had to find borrowed money. And Michael Milken got famous because he helped these investors sell bonds. And they kind of called them junk bonds. They had very high interest rates compared to other safer debt, which was the the lure for investors to buy these bonds. And then ironically, he ended up getting in trouble. I don't know if he was doing some shady deals on the side with these junk bonds, but I think he did some time in Pleasanton, California. You think I'm kidding? No, I think there was like a country club jail in Pleasanton or something like that. That's what one of my students told me this morning. I didn't realize it was in Pleasanton. I think he looked it up, or either he was pulling my leg. But he did some time in jail, and then after that, he couldn't do finance anymore, so he was teaching finance at UCLA. So that could have been interesting to take class with him, huh? Anyway, that's an interesting story. But you know, where there's a demand for money, and then people come up with new ways of getting that money. In this case, it was junk bonds. All right, so that's it for bonds.